Hey, I'm Juan. Thank you for joining me. Today I want to talk about Netflix and a possible swing trade opportunity. The market right now is bearish, and since 2009 we pretty much had zero interest, so we've had a big bullish market, and everything's been dropping right now because of the fear of the inflation, because of possible quantitative tightening, and all these things are going to affect growth stocks. They're going to affect intrinsic values of companies, and that's what's been leading to sell-offs. But for swing traders, sometimes these opportunities open or present us with possible trades. So the stock I'm interested in is Netflix, but I want to trade it, and I also want to protect myself just in case the market continues to crash. I want to kind of like hedge my own position, minimizing my risk during this market. It's important your strategy adjusts to the market. So let's look at Netflix chart. What's been going on? Netflix formed a head and shoulders. You can kind of see the head here, the shoulder, and the head and shoulder completed when it dropped below this area here, the 580, and now it's just been crashing ever since. I feel like it's going to crash a little bit more and maybe bounce into support in reverse, but I'm also worried that anything can happen in the market. If they do indeed initiate higher interest spikes, this is probably going to crash a little bit more. So how do I trade this in a way that's safe, just in case something's announced and it affects the stock more? Well, I do a credit spread. So what I'm saying, what I feel is that it's going to bounce off of 520 and reverse and go up if it crashes down here. But I think it's already falling into light support. So I think it's due for a turnaround, and if it doesn't hold, 520 has been strong support in the past, and I think there's going to be buyers in that area. There's also earnings coming up. I don't want to do too short of an option trade before the earnings, so I'm going out more towards February, which will give me time after the earnings. So my strategy to protect myself is buying a credit spread where I'm buying a put and I'm also selling a put down here in this 470 area, because it gives me more protection. And if it continues to drop, I can get out and minimize my risk. What is a bull put spread? You're trying to profit from neutral to bullish price action in the underlying stock. I am bullish on Netflix. I feel like it is going to turn around. I feel like this head and shoulders has completed, but we may be also trying to time and catch a falling knife. So there's some risk. So I am kind of neutral and bullish to the price. I'm not fully bullish. I'm kind of neutral bullish. I would sell one of XYZ at 100, the put 320, and also buy one XYZ at 95, and you collect this credit, which is $190. This is the goal of this strategy: collecting the option premium and limiting risk at the same time. So let's put in here a credit spread calculator. Netflix is currently trading at around 541. So if I wanted to take this strategy, which most likely I'm going to see Monday how Netflix opens up to see if I'm going to initiate this, but I would buy a February 18th put and I would sell a February 18th put. So that would give you a spread price of 86 cents. So that's what you collect. You collect 86 cents. You multiply that times 100. So you collect $86. So if you want to do 5 of these, then you just multiply $86 times 5. And that's what your potential profit is. Now, so the stock is currently at 541. Let's just say it drops down to here, 534, and then just consolidates. And come February, we were right, and it starts making a move back up like I anticipate, and it gets up to here, let's say 575. As long as before February 18th, this expiration date, if it's at above 550, close to the 560 area, then you're keeping the full premium. But even, you see here, as we get closer, even if it's at 540, you still collect the full premium. And if it drops a little, you still collect here. So there's about an 82% chance of profit, super high probability. Now, if it does crash here, let's say below 460, then you're going to lose a lot of money. You're going to lose $415 per contract. But you see here, I'm in control. If I see the stock is not going my way, or come February, it's still kind of consolidating between this 540 and 560 area, well, I can get out with profit if I want to get out during that time. So as long as this stock does not crash below 520 early February and closer to 500 late in mid-February, then I'm in good position. So that's why I take that, because I see so much support here at 520 that I really feel like it's going to hold. But if this doesn't hold and it drops, then my thesis is going to be wrong, and you're going to have to get out and take your loss. And that's where you decide how much you're willing to risk. Your chance for profit is about $86 per contract. So $86 per contract is your chance for profit. But you have the potential of losing up to $400 if you're incorrect. And at the same time, you have an 82% chance that you're going to be correct. So it's high probability, higher risk, lower reward, but I'm giving up reward for protection in my trade. So that was just a quick lesson on credit spread. And this was a bull put spread because I'm selling a put and buying a put at the same time. So the put that you're buying is lower than the put that you're selling. So for this one here, I would buy a 470 put, the February contract, and sell a 475. And that would give me that protection. Thank you for watching. See you on the next video.